Before we dive in, a quick note. You might notice that certain product names in this video have been edited or dubbed. This was done after recording at the request of one of the separate account managers we work with who asked us to remove references to their trademarked name. While the terminology has been adjusted, the strategy and insights we're discussing remain the same. Throughout this video, we'll refer more generally to tax-aware long-short, separately managed accounts, or SMAs. When it comes to your portfolio, you're neutralizing the added risk by using the short overlay, making what was risky leverage into market neutral leverage. The long and short positions work in tandem to generate tax alpha, and your richer retirement does not come from chasing investment performance. It comes from a smart tax strategy. This is about creating something nourishing and sustainable, not flash in the pan results. Hey there, I'm Hilary Hendershott, CFP and founder of Hendershott Wealth Management. This is video 4 in a 7-part series about our tax-aware long-short strategy that we deploy within our ultra-tax efficient wealth management suite of services. And in particular, how one tool in that suite is engineered to deliver tax alpha. If you've been watching so far, you know that is higher net returns that don't come from investment performance, but from smart tax strategy. In our last video, we went to the farm. In this video, we're stepping into the kitchen. Because the way our tax-efficient strategy works, it's a little like making a pot of stew. Let me show you what I mean. You start with a solid recipe. In that recipe, you've got high-quality ingredients, your carrots, your potatoes, your beans, your spices. That's your core diversified portfolio and the stocks you own inside it. These are your long positions. You own these stocks, and when they go up, you earn a profit. Think of this long-only portfolio with stocks, ETFs, or mutual funds as your stew's base. You put it on the stove and you let it simmer. Over time, the heat, that's the market, goes up and down a bit, but you trust the process. If you're patient, the flavors develop and the stew thickens. It takes time, but it works. That's the investing strategy of tax-aware long-short SMAs. It uses a core portfolio as collateral and adds a tax-aware long-short component for meaningful results. In this core position, you're counting on earning market returns steadily over time, much like that stew thickens. There's no additional strategy overlap and no borrowed money. Just time, patience, and good ingredients. But let's say you're really hungry and maybe a little impatient. You want results faster, so you turn up the heat. Now you're adding your long overlay. Your stew is cooking faster, and that's the leverage. You've borrowed money, your additional heat, to invest more aggressively and amplify your exposure. Here's the thing. You might get to the finish line sooner, but it's risky. Crank it too high and the stew boils over, and what should have been a delicious meal becomes a hot mess. Or you end up cooking off too much liquid, and you're left with vegetable mush instead of a savory stew. That's what high-risk leverage looks like. It has the potential to amplify your returns, but also your losses. Without protection or oversight, you could be playing with fire. Now, here's the part that surprises most people. Imagine a chef comes over and says, "Sure, turn the burner up and add stock, water, or wine. It won't dilute the flavor. It'll keep it just as rich." That seems counterintuitive because you'd expect more liquid to dilute the taste, right? But that's not the case if it's done right. And that's kind of how our strategy works. With the right proportions and care, adding more liquid can keep the stew from scorching, helps distribute heat more evenly, and allows deeper and fulfilling flavors to develop. That's how professionals scale a recipe without sacrificing taste, and how our tax-aware long-short overlay works. In investing terms, the long overlay is like adding more heat. It increases your market exposure by borrowing against your portfolio to buy more stocks. But instead of letting the pot boil over, you add the stock, water, or wine, which is the short overlay, with carefully selected positions that add counterbalance to the risk and keep the overall exposure steady. The result? Your stew stays balanced instead of boiling over. The ingredients keep breaking down to deepen the flavor, and now you have more to serve. Sooner. When it comes to your portfolio, you're neutralizing the added risk by using the short overlay, making what was risky leverage into market neutral leverage. The long and short positions work in tandem to generate tax alpha, and your richer retirement does not come from chasing investment performance. It comes from a smart tax strategy. This is about creating something nourishing and sustainable, not flash in the pan results. Leveraging a tax-aware long-short strategy obviously isn't a kitchen hack. It's a carefully constructed tax and investment strategy. Yes, the heat is high. Yes, you're borrowing with that long overlay. But our risk-managed short overlay keeps things from getting dangerous. This isn't reckless cooking. It's a gourmet level strategy. And what we're cooking is tax losses that reduce your capital gains tax bill without sacrificing returns or adding market risk. In many of the cases we see, tax aware long short is the most powerful tool for minimizing capital gains taxes. In fact, we've already seen just how effective it can be in allowing a business owner to sell for $12 million without incurring a nearly $3 million tax bill that would stop them from being able to buy their dream beach house and fully fund their retirement. Diversifying a $12 million concentrated portfolio over just 2 years without a $4 million tax bill and paving the way for a startup employee with a $9 million payout after her company's IPO to end up with an $8.6 million investable portfolio instead of a $5.6 million one after taxes, thereby compounding to $20 million over the next 25 years. With this tax-aware long-short strategy, you're realizing tax losses on purpose without actually losing value in your portfolio. You're maximizing tax efficiency and minimizing waste, much like a chef would do in their kitchen. It's controlled. It's deliberate. It's designed for real-life outcomes, not Wall Street speculation. And the final dish? Delicious. Low added risk. Great returns, plus tax alpha. So next time someone tells you that all leverage is risky, just smile and say, not if you know what you're doing. Because leverage isn't inherently dangerous. It's all about how it's used. When we use tax-aware long-short investing for suitable investors as part of our ultra tax-efficient wealth management services, we create real tax advantages that compound into significantly more long-term wealth while still being conservative about risk. If you're a suitable investor, that is, if you're holding a large taxable portfolio with at least $1.25 million in assets, and you want to understand how to minimize the drag from capital gains taxes, we'd be happy to walk you through it. Visit hendershottwealth.com/contact to schedule a complimentary up to 45-minute discover call with one of our lead advisors. We'll take the time to understand your financial picture, clarify your long-term goals, and help you evaluate the potential of a long-short strategy or others within our ultra tax-efficient wealth management suite to minimize your tax drag. And if we're not the right fit, we will point you to someone who is. Because you deserve advice that's profitable, personal, forward-looking, and always in your best interest.